What if I told you that the ETF sitting in your portfolio right now could be secretly costing you tens of thousands in lost returns? Or worse, what if the hot ETF your friend just recommended could end up destroying 60% of your investment in just a few years? In the high-stakes world of investing, one decision can be the difference between early retirement and years of playing catch-up. And today, we're about to settle the score. Welcome to the ultimate ETF Showdown of 2025, where 5 titans of the investment world will battle it out for a place in your portfolio. But this isn't your typical dry comparison video with boring charts and endless statistics. This is a no-holds-barred fight to determine which ETF truly deserves your hard-earned dollars. In today's arena, we have a fallen champion who once delivered a staggering 205% return during the pandemic, only to come crashing down in spectacular fashion. We have a monthly income specialist that promises safety but might be silently capping your wealth potential. There's a tech-focused powerhouse that's doubled investors' money since 2023, but has some critical blind spots. We'll see a dividend veteran with 13 consecutive years of increasing payouts competing against a balanced contender that might just offer the best of all worlds. The identities of these investment gladiators? That's part of the journey we're about to take together. I want you to judge each contender on their merits, not their names or reputations. Before we begin this financial cage match, know that I've put my own money into each of these ETFs at different points, learning their real strengths and weaknesses through gains and painful losses. The insights I'm about to share aren't theoretical, they're battle-tested. I can promise you this, by the end of our showdown, the winner may shock you. Your perspective on these popular ETFs will be forever changed, and most importantly, you'll know exactly which one deserves a spot in your financial future. The market waits for no one. The clock is ticking on your wealth-building journey. Are you ready to discover which ETF reigns supreme? If you will found this breakdown helpful, please hit that like button and subscribe to the channel. It really helps the video reach more investors who could benefit from this information. Let's take a moment to understand the investment landscape we're dealing with in 2025. This is the battlefield where our 5 ETF contenders must prove themselves. The market has changed dramatically in the past year. After the tech-driven rally we saw throughout 2024, investors are now facing new challenges. Interest rates have shifted, sectors are rotating, and what worked well last year might not be the strategy that wins tomorrow. According to JP Morgan's 2025 Outlook, the traditional 60-40 stock-bond portfolio that investors have relied on for decades is being reformed. Experts are now recommending diversification beyond just stocks and bonds to protect against market volatility. Why does this matter for our ETF Showdown? Because each of these 5 ETFs approaches diversification differently. Some focus heavily on a single sector, betting big on continued growth. Others spread investments across multiple industries, potentially sacrificing explosive growth for stability. For you as an investor, this means your choice isn't just about past performance numbers. It's about selecting the ETF that's best positioned for what's coming next. Think about it this way. If you were choosing a vehicle for a road trip, you'd want to know what terrain you'll be facing. Are you heading into mountains where you need power? Across deserts where reliability is key? Or through varied landscapes where versatility matters most? That's exactly what we're doing today, matching the right ETF to the financial terrain ahead. So as we examine each contender, keep this current market context in mind. The best ETF for your portfolio isn't just the one with the flashiest past performance, it's the one equipped to navigate what's coming next. Now let's meet our first competitor, a once mighty ETF that's fallen on hard times. Contender number 5, ARK Innovation, ETF ARKK. Coming in at the bottom of our rankings is a true cautionary tale of investing, the ARK Innovation, ETF ARKK. Let me tell you the dramatic story of this ETF. During the pandemic market crash of 2020, when fear was everywhere, this fund emerged as a seemingly unstoppable force. Led by its famous manager Cathie Wood, ARKK skyrocketed an incredible 205% from the March 2020 lows to its peak in February 2021. Investors flocked to it like moths to a flame. After all, who wouldn't want those kinds of returns? RKK became the talk of investment communities, with its bold bets on disruptive innovation, Bitcoin, and Tesla. But here's where the story takes a dark turn. Since those February 2021 highs, ARKK has collapsed, losing nearly 60% of its value. During that exact same period, the S&P 500 climbed 60% in the opposite direction. Think about that contrast. One investment cut your money in half while the other doubled it. Looking at the numbers today, ARKK manages about $6.9 billion in assets. Over the past 12 months, it's returned 34%, which sounds impressive until you realize it was down more than 10% through the first 10 months of 2024, only to be rescued by huge gains in Tesla and Palantir after the election. What companies does ARKK hold? Let's look at the top 10. Tesla, Roku, Coinbase, Roblox, Palantir, Robinhood, Shopify, CRISPR, Block, and Tempest. These 10 companies make up about 64% of the entire ETF. This concentration in high-risk, high-volatility companies explains the wild price swings. While delivering these disappointing results, ARKK charges you an expense ratio of 0.75%, one of the highest fees among popular ETFs. The lesson? ARKK appears to be what I call a one-hit wonder, spectacular during one specific market condition, but unable to deliver consistent results over time. For my money, this ETF will never find a place in my portfolio. Now, let's move on to our next contender, which offers a completely different approach to investing. Contender number 4, JP Morgan Equity Premium Income ETF. Moving up our rankings to the 4th position is JP Morgan Equity Premium Income ETF, known as JEPI. Think of this ETF as the steady income specialist in our competition. JEPI takes a completely different approach than our last contender. While ARKK swings for the fences with high-risk growth stocks, JEPI focuses on delivering consistent monthly income to investors. It's like choosing between a lottery ticket and a steady paycheck. Here's what makes JEPI different. It uses something called a covered call strategy. In simple terms, this ETF owns stocks, but also sells options on those stocks to generate extra income. It's like owning a house but also renting out a room to bring in additional monthly cash. This strategy gives JEPI its impressive 7.2% yield. To put that in perspective, for every $10,000 invested, you'd receive about $720 in annual income, distributed monthly. That's why many retirees and income-focused investors are attracted to this ETF. But there's always a trade-off in investing. JEPI's covered call strategy caps its upside potential during strong bull markets. Looking at the numbers, over the past 12 months, JEPI has only returned about 5%, while the overall market, S&P 500, climbed nearly 25%. That's the price you pay for that steady monthly income. Let's peek under the hood at what JEPI actually owns. Its top holdings include well-established companies like Meta Platforms, Amazon, MasterCard, Visa, Progressive, Alphabet, Trane Technologies, Thermo Fisher, Avery, and Southern. In total, the ETF holds 132 different positions, providing good diversification. JEPI charges an expense ratio of 0.35%, which is higher than some passive ETFs, but reasonable for an actively managed fund with a complex option strategy. So who is this ETF perfect for? If you're retiring soon or already retired and need regular monthly income from your investments, JEPI could be a great option. It's designed for the investor who values certainty and income over maximum growth potential. However, for investors like me who are still in the wealth-building phase and focused on total returns, JEPI's limited upside in bull markets keeps it out of my top 3 choices. Now let's move up to our middle contender, an ETF that takes a completely different approach by focusing on a specific sector of the market. Contender number 3, Vanguard Information Technology ETF. Now we're moving into the metal positions of our ETF Showdown with our bronze winner, the Vanguard Information Technology ETF, or VGT. This is the focused specialist of our group. VGT does one thing and does it well. It gives you concentrated exposure to the technology sector. While other ETFs try to be everything to everyone, VGT knows exactly what it is: a pure play on America's most innovative companies and the tech revolution. Looking at the numbers, VGT currently manages an impressive $99 billion in assets, showing just how popular tech investing has become. It offers a low expense ratio of just 0.09%, meaning you'll pay only $9 annually per $10,000 invested. For budget-conscious investors, this is a significant advantage over our previous contenders. The dividend yield sits at a modest 0.6%, but let's be honest, nobody buys VGT for income. This ETF is all about growth and capital appreciation. Speaking of growth, VGT's performance has been nothing short of spectacular in recent years. Since the start of 2023, after the tech sell-off in 2022, this ETF has nearly doubled investors' money with a return of almost 100%. During that same period, the S&P 500 was up roughly 60%. Now, let's look at what you actually own with VGT. The top holdings include technology giants like Apple, Nvidia, Microsoft, Broadcom, Salesforce, Oracle, Cisco Systems, Accenture, ServiceNow, and IBM. In total, the ETF holds 319 positions, but the top 10 account for about 60% of the fund's weight. Here's where VGT has a notable limitation. It strictly focuses on companies classified as information technology. This means it misses out on some of the world's most innovative companies like Amazon, Meta, Facebook, and Alphabet, Google, which are classified in other sectors like consumer discretionary or communication services. This is why VGT eventually exited my personal portfolio years ago. While I wanted heavy tech exposure, I also wanted those major tech-adjacent innovators that VGT doesn't include. VGT is perfect for investors who want to add a focused technology allocation to an already diversified portfolio. If you believe that technology will continue to outperform other sectors, as it has for much of the past decade, VGT offers a low-cost, straightforward way to make that bet. But for a more complete technology investment that includes all the major tech innovators, our next two contenders might offer better alternatives. Let's move on to our silver medalist, an ETF with a completely different focus that provides a valuable counterbalance to tech-heavy portfolios. Contender number 2, Schwab U.S. Dividend Equity ETF. Taking the silver medal in our ETF Showdown is the Schwab U.S. Dividend Equity ETF, ticker SCHD. If VGT is the exciting tech specialist, SCHD is the reliable veteran that quietly delivers results year after year. Many dividend investors might be surprised to see SCHD in second place rather than first. After all, this ETF has developed an almost cult-like following in dividend investing circles. But there's good reason for its position today, which I'll explain shortly. Let's look at what makes SCHD special. This ETF currently manages $68 billion in assets and charges an incredibly low expense ratio of just 0.06%, the lowest of any ETF in our competition today. That means you're paying just $6 annually per $10,000 invested, keeping more of your money working for you. Over the past 12 months, SCHD shares have risen about 9%, solid but not spectacular compared to the broader market. However, SCHD isn't designed to win any short-term performance contests. It's built for the long game. What sets SCHD apart is its approach to dividends. It currently yields 3.56%, which is respectable, but the real magic is in its dividend growth. SCHD has increased its dividend for 13 consecutive years with a 5-year dividend growth rate of approximately 12%. Think about that. Your income stream growing by double digits each year, far outpacing inflation. Looking inside the ETF, SCHD takes a very different sector approach than our tech-focused contenders. Its largest sector allocations are financials, healthcare, and consumer staples, with technology accounting for only 10% of the portfolio. This makes SCHD an excellent diversifier for tech-heavy portfolios. The top holdings include quality companies like AbbVie, Pfizer, Amgen, Bristol-Myers, Cisco Systems, Coca-Cola, BlackRock, Home Depot, Chevron, and Verizon. In total, it holds 102 positions with the top 10 accounting for about 42% of the fund. Here's something interesting that many investors are watching closely. SCHD goes through its annual reconstitution every March, potentially bringing new companies into the fold. This upcoming change has many dividend investors excited about potential improvements to the already strong portfolio. SCHD is perfect for three types of investors: those approaching retirement who want to build a growing income stream, younger investors looking to balance out technology exposure, and anyone who values stability and consistent growth over flashy returns. While SCHD isn't currently my #1 pick, it remains a cornerstone of many successful dividend portfolios, and for good reason. It provides something increasingly rare in today's market: reliability. Now, let's move on to our gold medal winner, an ETF that combines the best elements of our other contenders in one surprisingly versatile package. Contender number 1, Invesco QQQ ETF. And now we've reached the top of our ETF rankings. The gold medal goes to the Invesco QQQ ETF, ticker QQQ. This might surprise some viewers who expected SCHD to take the crown, but let me show you why QQQ deserves the #1 spot in 2025. QQQ offers something truly special: a perfect balance between focused growth and sensible diversification. While many see it as just the tech ETF, QQQ is actually much more sophisticated than that. Let's break down what makes QQQ special. This ETF is a heavyweight, managing an impressive $330 billion in assets, the largest in our competition. Over the past 12 months, it's delivered strong returns of 12%, nearly matching the broader market's performance. QQQ charges a reasonable expense ratio of 0.20%. That's $20 annually per $10,000 invested. If you're simply buying and holding long-term, there's even a lower-cost version called QQQM, with a slightly reduced fee, though the regular QQQ remains superior for those using option strategies. Here's what really sets QQQ apart: its perfect balance. Technology makes up about 50% of the fund, giving you excellent exposure to the sector driving most of today's innovation and growth. But unlike VGT, the other 50% is diversified across other sectors, providing much-needed balance. QQQ also solves VGT's biggest weakness by including those tech-adjacent innovators. The top holdings include familiar names like Apple, Microsoft, Nvidia, and Amazon, but also include Broadcom, Meta, Tesla, Alphabet, and Costco. In total, QQQ holds 102 positions, with the top 10 accounting for more than 50% of the fund. Another major advantage of QQQ is its liquidity and options availability. As one of the most traded ETFs on the market, QQQ offers excellent options opportunities for those looking to generate additional income or hedge their positions. This versatility makes it valuable for both buy and hold investors and more active traders. So why is QQQ my #1 pick for 2025? It offers the perfect combination of growth potential through its technology exposure, diversification through its multi-sector approach, versatility for different investment strategies, and consistent long-term performance. Whether you're a growth investor looking for innovation exposure, an income investor using options for cash flow, or simply someone looking for a quality core holding, QQQ delivers what matters most: balanced results that can serve as the foundation of a successful portfolio. I'd love to hear how you would rank these 5 ETFs for your own portfolio. Would you place them in a different order? Is there another ETF you think deserves to be in this top 5? Let me know in the comments below. If you found this breakdown helpful, please hit that like button and subscribe to the channel. It really helps the video reach more investors who could benefit from this information. Thanks for watching this ETF Showdown. Remember, the right ETF for your neighbor might not be the right one for you. Focus on your specific goals, time horizon, and risk tolerance when making your decision. Thanks for investing your time with me today. This content is for educational purposes only. Always conduct your own research and consult with a financial advisor before making any investment decisions. Past performance does not guarantee future results. Thanks for watching, and I'll see you in the next analysis.